Let's dive right into this explainer on exactly how to formalize your business structure in California. Today, we're putting the LLC, C-Corp, and S-Corp options under a microscope, treating this like a rigorous, detailed review. If you're an informed entrepreneur operating in the Golden State, you already know choosing the right entity is about way more than just picking a cool name. It dictates your liability, your administrative overhead, and most importantly, your tax burden. So we're stripping away the fluff. We're going to look exclusively at the hard data, the exact filing requirements, and the rigid financial thresholds that really need to drive your decision. This video contains affiliate links. I have a relationship with the brands in this video and earn a referral fee when you shop through the links in the description below. Before we dive into the exact steps of registering your business in California, let's talk about your foundation. You absolutely cannot build a successful brand or protect your personal assets without a properly structured legal entity. Most people try to launch in the Golden State as a sole proprietor or cut corners on their state filings. And that is exactly why they face massive personal liabilities or get crushed by California's strict business regulations. Whether you decide to structure as an LLC, a C-Corp, or an S-Corp, your business must be a legitimate, separate legal entity in the eyes of the Secretary of State. That's where Busy comes in. Busy is the absolute best formation service out there, handling your entire California business setup for just $0 plus state fees. They take care of all the heavy lifting for you, filing your articles of organization or incorporation, providing your legally required California registered agent, securing your EIN, and setting up your ongoing compliance alerts. This is non-negotiable if you want to operate legally and protect your wealth. I've linked my full, in-depth review of Busy in the description so you can see exactly why I recommend them. Make sure to use my link down below to get your California business set up right through Busy today, which will also unlock exclusive discounts and perks. Section 1. What is business registration in California? Defining the legal and tax frameworks. So here's the most common misconception business owners make right out of the gate. An S-Corp isn't actually a distinct business entity. You can't simply form an S-Corp directly with the California Secretary of State. Nope. You actually have to create an underlying legal entity first, either an LLC or a C-Corp. Once that's done, you elect for it to be taxed under Subchapter S by filing a specific form with the IRS. And the state of California, they automatically honor that federal election. Let's jump into Section 2. Key features and steps, exact filing paths and costs. Creating a California LLC is a highly streamlined procedure. You start by appointing a registered agent with a physical street address in the state. Then you submit your articles of organization, specifically Form LLC-1, through the BizFile online portal, which comes with a $70 filing fee. Crucially, within your first 90 days, you absolutely must file an initial statement of information for $20. Finally, California law mandates that all LLCs create an operating agreement to outline member rights and profits. Even though this document is just kept in your internal records and not actually filed with the state, do not skip it. This agreement is your primary shield if there's ever an internal dispute, fully cementing your limited liability status. Now, for a standard C-Corp, the path is significantly more formal. The initial filing requires the Articles of Incorporation, that's Form ARTS-GS, which carries a slightly higher state fee of $100. Just like the LLC, you have a mandatory 90-day window to file your initial statement of information, but the fee here bumps up to $25. On top of that, a C-Corp requires rigid administrative formalities right from day one. You've got to draft corporate bylaws, appoint directors, issue actual stock certificates, and formally hold an initial board meeting. If you're going after S-Corp taxation, the clock starts ticking the exact moment your LLC or C-Corp is formed. You have to file IRS Form 2553 within a very tight 75-day window from your formation date. Miss this, and your election might be delayed a full year, which completely alters your tax strategy. And here's the major catch. This federal form requires the unanimous consent, complete with physical signatures of every single allowable shareholder. If even one shareholder refuses or happens to be ineligible, the S-Corp election fails immediately. No exceptions. This brings us to the ongoing compliance differences between the entities. Once formed, you have to maintain your good standing to keep that liability shield intact. An LLC enjoys a much lighter administrative burden, paying a $20 statement of information fee biannually, meaning every 2 years. Corporations, on the other hand, whether they're a C-Corp or S-Corp, are required to file this statement of information annually, paying $25 every single year. And a quick warning, missing these regular filings results in a harsh $250 penalty, and eventually the suspension of your business rights in the state. All right, let's talk about the number that catches nearly every new business owner totally off guard, $800. Regardless of which entity you choose, whether you're wildly profitable or operating at a total loss, you have to factor in the pleasure of doing business in California tax. Think of it as a mandatory cover charge just to get in the door. It's an inflexible $800 minimum annual franchise tax due to the Franchise Tax Board. And note this carefully. Recent legislation known as AB 85 has completely expired, meaning there is no longer a first-year exemption for new LLCs. You owe this fee from year one, period. Moving on to Section 3, Real-World Practical Applications, Matching Structure to Strategy. The source data clearly maps specific operational profiles to these structures. Freelancers and solo operators naturally gravitate to the single-member LLC for its baseline liability shield and sheer simplicity when it comes to maintenance. High-growth startups, however, almost exclusively need the C-Corp. Why? Because venture capitalists absolutely demand it for its unlimited share structures and familiar corporate governance. And S-Corps? They're utilized by highly profitable small businesses that are specifically aiming to minimize self-employment taxes through structured payroll and strategic distributions. If you are eyeing the S-Corp for its tax benefits, there's one absolute key metric to watch. That $40,000 to $50,000 net profit threshold is your crucial tipping point. Below this amount, the mandatory costs of running compliant quarterly payroll, filing complex 1120S corporate tax returns, and paying general accounting overhead will actually wipe out any federal self-employment tax benefits you might have gained. To put it simply, the S-Corp is an optimization tool for established revenue, not a starting line for brand new operations. Section 4. Pros and cons compared. Let's strictly evaluate the trade-offs. Starting with the LLC. The pros are genuinely excellent. You get simple pass-through taxation, meaning no separate corporate tax rate. You also have highly flexible management rules and robust personal liability protection. But the cons in California are severe for high earners. On top of that $800 minimum tax, if your LLC's gross receipts cross $250,000, you're hit with an additional income-based fee. And pay very close attention to the word gross. This is based on total income, not your profit. If your total California gross income exceeds $5 million, that extra fee scales all the way up to an astonishing $11,790 every single year, eating directly into your margins. Now a C-Corp. It's perfectly optimized for issuing stock. It places literally zero limits on the number or type of shareholders you can have, making it the undisputed vehicle for raising outside capital. However, it suffers from the infamous double taxation. The corporation itself pays taxes on its profits, and California imposes a hefty 8.84% corporate income tax rate on those earnings. Then, after that tax is paid, shareholders are taxed a second time on their personal income returns when they actually receive those remaining profits as dividends. The S-Corp is a powerful hybrid option. At the federal level, it saves you 15.3% on self-employment taxes by allowing you to split your income into a reasonable W-2 salary and separate dividend distributions. But California uniquely penalizes this structure. While the IRS considers an S-Corp a pass-through entity, California imposes a specific 1.5% state-level tax on your S-Corp's net income. Furthermore, you're handcuffed by rigid IRS requirements, including a maximum limit of 100 allowable U.S. shareholders, and absolutely none of them can be other corporations or non-resident aliens. Section 5. The final verdict and summary. Which registration path is right for you? Based solely on the hard data we've reviewed, your path becomes pretty clear. Start with an LLC if you're a solo operator needing baseline liability protection without wanting to drown in ongoing corporate paperwork. Opt directly for a C-Corp if you are chasing venture capital. Quite simply, your investors will absolutely demand it before handing over a check. And elect S-Corp status only when your net profits easily outpace that $50,000 threshold, allowing your federal tax savings to comfortably absorb both California's unique 1.5% penalty tax and your added payroll compliance costs. So before you file a single document with the Secretary of State, ask yourself this final question. Do your actual realistic revenue projections right now justify the heavy administrative overhead and that mandatory $800 minimum tax? Look, legal structures are incredibly powerful tools for growth and tax optimization, but deploying them too early can become a costly administrative trap here in California. So are you registering to truly optimize your profits, or are you just paying for a fancy title? Evaluate your numbers closely, choose strategically, and protect your bottom line.